Theta strategies are one of the greatest hacks to options trading. While everyone else keeps losing money from theta eating away their options, if you learn these strategies today, more often than not, you're going to turn a profit. Let's talk about it. Hi y'all, my name is Greg and I make videos about the stock market and options trading. Today we're going to be talking about theta and some of the best strategies I know for this. So to break this video down for you, first I'm going to walk you through each strategy and the basics behind it. Then I'm going to show you a real example using Robinhood. And finally, I'll show you the risks and the rewards that come with each of these strategies. But before we get into it, if you want to see what options I'm trading every day, make sure to check out my Patreon, link down in the pinned comment below. First, we should probably define theta for those who aren't caught up. And if you don't know what theta is, basically it's the amount by which your option loses for every day that passes. This means that the theta value for your option is negative 0.3, your option will lose 30 cents or $30 of total value each day that goes by. But theta actually isn't linear. It looks something like this. As your option's expiration date approaches, theta is going to increase, meaning that your options are going to lose more and more value as time goes by. Generally, the last 30 to 45 days is when your option will lose the most value from theta, and this is what we call theta decay. This is why most people lose money whenever they're buying short-dated options. But once you learn to use theta to your advantage, you can actually start making a profit. The first and the most common theta strategy that I know is the wheel, and the wheel is made up in two parts: cash secure puts and cover calls. With a cash secure put, you're going to begin by selling to open a put option. And when you sell this put option, you're agreeing to buy 100 shares of your stock at your strike price on or before your expiration date. And for this, you're going to get paid a credit, or what's called premium. In order to cover the cost to buy 100 shares, you're going to have to put down cash or collateral in order to open your trade. The amount of cash that you need in order to do this is going to depend on your strike price. Multiply your strike price times 100, and that's how much cash is required for your trade. A stock that I've been using this strategy on consistently lately has been Weedmaps, MAPS. Right now the stock is trading for $14.16, and I want to buy 100 shares of this at $12.50. In order to do this, I would sell the $12.50 put that's expiring next month, August 20th, that's going for $70 of premium. Whenever I sell this option, I get to collect that $70 up front, and it doesn't matter if MAPS is going up, down, above $12.50, below $12.50. I get to keep that $70 no matter what, unless I buy this option back in order to close the trade. Your strike price and your expiration date are going to be a personal preference, but generally the best practice for selling puts would be a negative 0.3 delta and 30 to 45 days until expiration. This option here has 37 days to expire and a negative 0.27 delta, which is about close enough. If MAPS is trading above $12.50, my strike price, on my expiration date, I get to keep the $1,250 that I had to put down as collateral, and I get to keep the $70 that I was paid in premium. However, if MAPS is trading below $12.50, I'll have to buy 100 shares of the stock at $12.50. This is going to be the case for all cash secure puts. For when the stock price falls below your strike price and stays below it at the expiration date, you're going to have to buy 100 shares at the strike price that you chose. Your option can also be assigned before the expiration date if the stock falls below your strike price, but the chances of the buyer exercising their option early is pretty low. Generally, that's not something that you have to worry about. But whenever you get assigned on a cash secure put and you had to buy 100 shares of your stock at your strike price, since you collected the premium and you didn't buy your option back, this is actually going to bring down the cost basis for your 100 shares. In this case, with this MAPS cash secure put, I got $70 for $12.50 strike price, so we'd subtract the 70 cents for this option from the $12.50 strike price, and technically we'd only be paying $11.80, and that's going to be what's known as our break even. You can calculate the break even for any cash secure put by subtracting the premium that your option was going for from the strike price that you chose. And once you get filled on one of these cash secure puts and you have to buy 100 shares, once you have those 100 shares, then you can start using the second half of the strategy, covered calls. You'll start out by selling a call option to open, and whenever you sell this call, you're agreeing to sell 100 shares of your stock at your strike price on or before your expiration date, and for this trade, you're going to get paid a credit or premium. In order to put on this trade, you're going to have to put down 100 shares of collateral, just like with a cash secure put, but instead of putting money down on this trade, you're going to have to put your 100 shares up for grabs. Just like with a cash secure put, the best strike price and expiration date is going to be a 0.3 delta and 30 to 45 days till expiration. The 1750 call has a 0.27 delta and 37 days to expire, which is just about ideal. For this option, I'll get paid $63 in credit, and that $63 is mine unless I buy this option back before it expires in order to close it. If MAPS is trading below $17.50, my strike price, when this option expires on August 20th, I'll keep my 100 shares and the $63 of premium that I received. If MAPS is trading above my $17.50 strike price on my expiration date, August 20th, then I have to sell 100 shares at $17.50, but technically I'm actually not selling these shares for $17.50. I'd actually be selling them for my break-even price. In this case, we would add the 63 cents from the premium to the $17.50 strike price for a break-even of $18.13. To calculate your break-even for a covered call, add the premium that you received to the strike price that you chose. Once you get filled on a covered call to sell 100 shares of a stock, you can keep the wheels turning by selling cash secure put again. If you keep using the strategy for long enough, you can actually generate some pretty sweet returns. With MAPS, the premiums were going for around $66 on average, and if we kept selling these each month, we'd make about $800 in a year, which is around a 57% return. Generally, whenever the stock goes up in price, the premiums will follow, so if MAPS were to double to $30, maybe we'd be making $1,600 a year. But the risk here is if MAPS keeps falling, the premiums are going to shrink with the share price. If MAPS were to fall by 50%, I'd be getting around half the premium that I am now, or $400 a year, which is still around a 28% return, pretty good, but we still lost half of our investment. So in order to make up for that, we would need 100% return. Another drawback of the wheel strategy is that it has a pretty high barrier to entry. You need a lot of money in order to put on these trades. If you want to do this on a stock like Apple, the price puts this out of reach for most investors. But if you don't have enough money, you can use this next strategy instead. Credit spreads are a great strategy for when you don't have enough money to buy 100 shares of a stock. This is pretty similar to cash secure puts and covered calls, where you'll start by choosing a strike price you think the stock price will be above or below, and if you think the stock price is going to be above a certain point, then you're going to use a put credit spread. For this, you'll start out just like with a cash secure put by selling a put option to open at a strike price you think the stock price will be above. But since you don't have enough money to buy 100 shares of your stock, you're going to have to buy a put option with a lower strike price. Just like with a cash secure put, the best expiration date is going to be 30 to 45 days out, so we're going to choose an August 20th expiration and search for a put with a 0.3 delta. The closest option right now is going to be this 140 strike price, so we'll sell this put option to open, and then we're going to buy a put option below this. Just like with a cash secure put, you're going to have to put down cash or collateral to put on your trade, but since you're buying an option, this is going to reduce your cost significantly. If we wanted to put down just $1,000, we would buy back this 130 and we would receive $140 in credit in order to put on this trade. If Apple was trading above our top strike price, 140 at our expiration date, August 20th, then we'll keep that $140 of credit. But if Apple is trading below 130, our lower strike price on our expiration date of August 20th, we're going to realize a max loss of $860. The way this can be calculated is by taking the difference between the two strike prices, $10 in this case, and subtracting the premium from that, which is $1.40, which brings us to $860 or $860. If Apple is trading anything between our two strike prices, 130 and 140 on our expiration date, then we might be at a profit or we might be at a loss, and this is going to depend on our break-even price. The break-even for a put credit spread can be calculated by taking the top strike price and subtracting the amount of premium that you received. In this case, it's 140 minus our $1.40 of credit for a break-even price of 138.60. So if Apple's trading anything above 138.60 on our expiration date, we'll be at a profit, and anything below 138.60, we're going to be at a loss. The amount of loss or gain from a credit spread can be calculated by taking the difference between your break-even price and whatever the stock price is at your expiration date. This is going to go for call credit spreads too, but in the opposite fashion. With a call credit spread, just like with a covered call, you're going to start by selling a call option to open at a strike price you think the stock price is going to be below on your expiration date. And since you don't have 100 shares of your stock in order to cover your trade, you're going to have to buy a call option with a higher strike price. We'll set our expiration date the same way, 30 to 45 days out, landing us at the 8/20 expiration, and we're going to find a strike price with a 0.3 delta. This 155 call has a 0.29 delta, which is close enough. We would sell this call option to open, and if we wanted to put down just $1,000 on this trade, we would buy the call option with a 165 strike price. For these two call options, we get paid $144 in credit, and if Apple's trading below 155, our lower strike price at expiration, we get to keep that 144 credit. But if Apple's trading above 165, our higher strike price at expiration, we're going to take on our max loss. Again, just like with a put credit spread, you can calculate your max loss by taking the difference between the two strike prices, $10 in this case, and subtracting the amount of premium that you received, $144 here, and our max loss for this call credit spread will be $856. If Apple's trading between our two strike prices, 155 and 165 at expiration, we're going to be at a profit. If it's below our break even, which in this case will be the 155 strike price, the lower strike price, plus the credit received, 144, for a break even price of 156.44. Anything above that 156.44 break even, we're going to be at a loss. And the amount of loss that we take on can be calculated by taking the difference between the stock price at expiration and that 156.44 break-even price. If you keep using these credit spreads on Apple, you should make around $140 a month, which would be around 168% yearly return based on the $1,000 of collateral. But that's only if you continue to get these trades right. Even if you get just one wrong, you would lose $860, and in order to make up for that, you would have to get 6 more correct. Chances are you're probably not always going to get the direction right, and if you suck at choosing the direction for the stock and you feel like you're always getting it wrong, this next strategy is for you. The covered strangle is a great strategy for when you don't know which way a stock is going to go, or if you think the stock is going to trade sideways. The strategy is basically the combination between a cash secure put and a covered call. Just like with a cash secure put, you'll need enough money to buy 100 shares at your put strike price, and you'll also need 100 shares of the stock for your covered call. Just like with a wheel strategy, we'll set our expiration date 30 to 45 days out, and we'll set our delta for 0.3 on each option. Since we already did these trades earlier, we know to sell the 1250 put and sell the 1750 call. For selling these two options, we'll get a total of $135 of credit or premium. Just like with a cash secure put, if MAPS is below $12.50, our put strike price on our expiration date, we have to buy 100 shares of MAPS at $12.50. And if MAPS is trading above $17.50, our call strike price, we have to sell 100 shares of MAPS at $17.50. If MAPS is trading anything between $12.50 and $17.50 on our expiration date, we get to keep both the cash that we put down and the shares that we put down as collateral. And also, since we didn't buy the option back, we get to keep our $135 credit no matter what. This means the real cost if we were to get assigned on our short put option would be $12.50 minus $135 credit. This means the break-even price for the put option would be $11.15. And the break-even for the call option, if we had to sell 100 shares at $17.50, would be $17.50 plus the $135, or $18.85. In this case, our total investment would be $14.10 plus the $12.50 that we put down as collateral for the put option, or $2,675. If we continue to use this strategy, we'd make $1,620 over the course of a year, which is around a 60% return. Of course, just like with a wheel, it depends on if the stock goes up or down, and we could make more money if the stock keeps going up, or we can make less money if the stock continues to go down. And since our total investment is $26.75, this puts us out of reach for a lot of investors. So if you don't have enough money for this strategy, then this next one is even better. The Iron Condor is a great strategy for people who can't afford 100 shares and for people who suck at choosing the direction for a stock. This is basically the combination between a put credit spread and a call credit spread, where you start out by choosing 2 strike prices you think the stock price will be between. To start out, we'll set our expiration date 30 to 45 days out with an August 20th expiration date. We'll sell to open a 140 put since it has about a negative 0.3 delta, and then we'll buy to open a 130 put just like we did before, so we only had to put down $1,000 of collateral. And then we'll sell to open the 155 call and buy to open the 165 call, like with our call credit spread from earlier. For all these options, we'll get paid $278 in credit, and the great thing about the strategy is we only have to put down $1,000 of collateral. Since Apple can't simultaneously be below 130 and above 165 on our expiration date, we only have to put down $1,000 on this trade like we would with a single credit spread. If Apple is trading below 130, our lowest strike price on our expiration date, we're going to be at a max loss, which is going to be equal to $1,000, the collateral that we put down, minus the $278 credit that we received for this trade. Same thing goes for if Apple is trading above our highest strike price, 165 on our expiration date. Either way, our max loss is going to be $722. If Apple's trading anything between our 2 middle strike prices, 140 and 155 on our expiration date, we'll be at a max profit, $278 of the amount of credit that we received. And if Apple's trading either between 130 and 140 or between 155 and 165, we can calculate our profit or loss from the break-even price. In this case, the break-even would either be 137.22, 140 minus our 278 credit if Apple goes down, or 157.78, 155 plus our 278 credit if Apple goes up. Anything below 137.22 and above 157.78 will be at a loss, and anything below 157.78 and above 137.22 will be at a profit. If you continue to use the strategy and you're right every single month for a year, you make $3,336 from $1,000 of collateral, which would be around a 236% return. But the odds of Apple trading flat every single month for an entire year are pretty low, but never zero. The best parts about the strategy is you only have to put down $1,000 of collateral, and even if you realize max loss one time of $722, it would only take a few times of getting this right in order to make up for that. If you want to make up for that loss even quicker or make even higher returns than the Iron Condor, then this next strategy is brilliant. The Iron Butterfly is almost identical to the Iron Condor since you're opening both a call credit spread and a put credit spread, but the difference here is you're going to select one strike price you think the stock price is going to be immediately at, on your expiration date. You're going to sell both a call option and a put option on the strike price you think the stock is going to be on your expiration date. And in order to cover the cost of buying or selling 100 shares of your stock, you're going to have to buy a call option and a put option. Just like all of our other strategies, we'll set our expiration date 30 to 45 days out, August 20th again, and we'll start by selling a call we think Apple will stay at on August 20th. If I think that Apple won't move hardly at all, I'll sell this 150 call, and then I would sell a 150 put, and then we would buy back a call and a put with a 0.3 delta. For all of these options, we'll get a massive $570 of credit, and if Apple is smack dab at $150 on our expiration date, we'll realize that full $570 of credit as our max profit. If Apple is trading anything below 140, our lowest strike price on our expiration date, we'll realize our max loss. But if it's trading above 155, our highest strike price, we'll actually make a profit here. This is because the credit that we received was $575, and since the difference between our call options is only $5, we'd actually come out with a profit of $75. If Apple is trading anything above or below 150 and between 140 and 155 at our expiration date, we'd calculate our profit or loss by taking the difference between the share price at expiration and our strike price, and if that difference is greater than $5.75, we'll be at a loss, and if it's less than $5.75, we'll be at a profit. So in this case, anything above 144.25 will make a profit on this trade. Stocks like Apple don't tend to trade flat for long periods of time though, so you might want to use a bullish strategy, which I'll cover next. The poor man's cover call is a great strategy for a stock that consistently goes up. The way this works is you'll start out by buying a call option with 6 to 12 months until expiration, and since your expiration date is so far out, you really don't have to worry about theta decay too much. And in the meantime, if you want to make profits from theta, you'll start selling call options with 30 to 45 days until expiration. To start off, we'll set our expiration date at least 6 months out. In this case, we'd choose the March 22 expiration date. We'd buy an option with a 0.7 delta, which for now is the 135 call. And in order to profit from theta, just like with all of our other strategies, we're going to set our expiration date 30 to 45 days out, August 20th again, and then we're going to find an option with a 0.3 delta. This means we would sell the 155 call for now, and we would get paid $210 for selling this option. But we also have to cover the cost of the 135 call expiring next March for this trade, so we'll have to pay up $1,855. As long as Apple stays below 155 on our expiration date of August 20th, we get to keep the $210 of credit that we got from selling this option, and then we can go about selling another call option next month. As long as Apple continues to stay below our short strike prices, we get to keep collecting that premium, and we get to continue to hold the call that we bought. If Apple keeps going up in the meantime, the call that we bought should continue to gain value on top of the premium that we keep collecting, but if Apple goes up too fast, then we might run into some trouble. If Apple goes above 155, our strike price on our expiration date, we're going to have to sell 100 shares of Apple at 155. When we get assigned on the short call, since we don't have 100 shares of Apple, we're going to have to exercise our 135 call that we bought. To calculate your profit or your loss from this scenario, you would take the difference between the two strike prices, which is 155 and 135, $20 in this case, and subtract the amount of debit that you paid for these two options, which was $18.55. In this case, we'd actually come out with a profit of $145. But if the difference between the two strike prices was less than the debit that we paid for our option, $18.45 again, we'd be at a loss. So say this difference was $15 instead of $20. In this case, we'd actually be losing $355. Another way that we might lose money from the strategy is if Apple continues to go down, and if it's below 135 on our expiration date, which was March of 2022, we would lose the entire $2,065 that we put down to buy that call. Hopefully you will continue to sell call options and keep collecting premium. That way you can mitigate some of those losses. And that's all the best theta strategies I have for you today. If you want to know what options I'm trading next, I post all my trade alerts and I hold live trading sessions over on my premium Discord, which you can find on my Patreon, link down in the pinned comment below. And before I go, I want to say thank you to all my patrons for the support. Thank you for making it all the way to the end of this video. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye guys.